Hello and welcome to another video. In this video, we'll cover the Xerox holding corporations. And the ticker name is XRX. My name is Pramod Kumar. I am a CFA charter holder and FRM certified. This is the company information from the 10K. It's listed in New York and you can easily see. So we'll see. Now the question is, you might be thinking, okay, why? This is a very old company. Why we are looking into this? The reason why I'm looking into this is, if you can see, this is the 1 year chart on the Yahoo Finance of this company, Xerox, right? And since almost 1 year, it's dropped heavily from almost $38 and then it never go back, right? So it's just when the stock crash, it's just moving here and there. It goes a little bit up immediately, but then you can see it's pretty much flat here, right? It still have a lot of room. So when I see that it's still 50% down from its peak, so a lot of room to grow. So now the question is, does this make a very good in terms, what's the fundamentals of the company is saying? Because right now we do have many growth stocks available, but the growth stocks, if the market does the corrections again, I think people we should be looking more into the value. So, and value, how we'll find the value, not by the price, but to see how the company financials are speaking. So that's what one of the reason we'll go deep dive into the company financials and see whether it's make a good sense or not. Okay, so let's go step by step. I have agenda there and I'll go very deep into the models. If you have seen in my past video, you'll notice that. Okay, let's get started without further delay. So the dividend, the good thing is about this company is the dividend paying company, and the company is consistently paying the dividend. And the period I have taken is 2011 to 2019. This is the annual period. So this is the dividend per share. So if you can see, the company is paying the dividend and it's growing, which is a good sign. So if I'm seeing from the valuation, from the very high price over sales or price over equity perspective, the company is the price over sale, which is on the green sign, is pretty much, you can see, is very flat. But with the recent, seems like the company is going up, and now in 2019 is 4 times is on this price over the sales as compared to the early, right, 2017, where it was $2 and some cents. So that's on the price side. So in the past, the company literally was not expensive, right? We can see clearly for the many years in the from 2011 to 2015, which we only need to pay even up to 14 is less than $1 what the company is earning. But now looks like the company is getting expensive. Now the question is why, right? If you see the PEPs jumps, is it some of the driving the growth, or what's the company is doing? Why people are suddenly paying so much for the company, right? So that should be the good questions to answer. So let's go a little bit deeper, and just like the onion, right, we'll peel one layer at a time. This is from the income statement. As you can see, we have 3 different hubs on the gross margin ratios, operating margins, and the net profit margins, right? The company from the 2011 does a pretty good job, 12 also, but you can see then from 13 to almost like 17, the company is doing worst. It destroyed its value, right? Everything is negative. But suddenly, starting from 2018, you can, I highlighted here, the net profit margin is huge. It jumps to 141%, and in 19 it's even 85.13%, which is huge. So this means the company is doing pretty good in terms of generating the net profit. And we'll see, I'll also show you once I'll do the net profit model, use the net profit model, the per year, how much the company is doing. So let's quickly check on the liquidity of the company before we see what's the fair value of the company. Is the stock is supposed to be trading at $12, $19, or it should be the higher, right? Go back to 40. So the liquidity side, this is over 1, and the cash is 33. So overall, it's not bad. So the liquidity is good, right? So let's quickly go to the models of the intrinsic value, right? Where I'll use 3 models to come up with the pricing. Okay, so I'll use the 3 model first. If you saw my earlier videos as well, you already noticed that the first is net profit, and then enterprise value, and then the free cash flow model, and then I'll come up with some final price, right? So as you can see here, in 2010 the company was doing very well in terms of the revenue, right? And then because of those years from 14 to 18, it's destroyed its value. So you can see the revenue, which was 21 billion, come down into only 12 and then 9 billion. But right, and same thing, if the top line is destroying, the bottom line is also destroyed as well. But overall, now it seems like the company is coming back, right? Where it's, so maybe yeah, wow, $6 per share. So you can see this company does very well if from the earning per share basis, right? So, and which we can easily say here, you can see in 3 years the net profit margin is 90.73%, whereas in the 5-year it's 24%, right? So I use this model, and honestly speaking, I try my best to be very, very conservative in all to come up with the intrinsic value of this model. So as you can see, although the last 3 years the net profit margin was almost 91%, or in 5-year or 10 years, but I still use a very conservative 8 years the percentage, and then this the profit growth, because you never know, right, what will happen in next. Maybe the company is for 1 or 2 years is fake growth and it come back. So that's one of the reason. So, and not only that, and then I'll destroying the growth every year, right, by a few basis points to come up with the 2% growth, and then I assume it's go as with the GDP, right? Okay, and then after the 2030, this is for 10-year projection, and then I sell the company as 3 times of its net profit, which is also very conservative. Okay, so right now the price of the share is 19.73. So, and the discount rate is 10%. I'm always use 10% discount rate. Okay, so once I did everything like this, then my price for this model is 71, right? So this model is with the profit model, assuming, oh, the company is doing very well. Okay, let's see what other 2 models are also come up before we do make any suggestions. Value model, and in this model, as you can see, this is very data intensive. So the idea behind this model is we'll go and buy as a whole company, and we'll consider a debt as well, and then the cash, and what's the market value. So we don't left anything behind and say, okay, now I'm going and buying the whole business, right? Rather than just trying to see from the net, only the net profit perspective. Okay, so in this model, again, I have taken the whole 10 years of data, and then if you can see here the company, so this is the enterprise value, right? And I have shown here how I come up with this enterprise value. So before I so enterprise value is once you have the data, is not a very heavy computations, so we can have the market cap plus debt and then less the cash flow, right? So that's how it is. And you can see the company enterprise value, if I see from the last 10 years, is destroying by the rate of 8.73% basis, right? And the last 3 years is even worse, is by almost 15%, right? And if I see the ratio of EBITDA, the EBITDA it was worse by also destroying by the rate of almost 6.56% or almost 7% for the last 10 years, but for the last 3 years it was only less than 1%, which is a very good sign. So this means the company is doing good, right? So if I come up with the EV over EBITDA, which means if I go as a company and buy this, then I can get my money back within the almost within the same range, right? So that's pretty good. But and also the debt and over the EBITDA, the ratio is pretty consistent. What it was almost 10 years is 2.71, and it's close to 2.66, right? So that's good. The company is generating enough enough operating income before taxes and depreciation amortizations to cover up its debt. So that's pretty good. So with this model, what I have done, I have taken the EBITDA growth rate of 6 point, the worst one as usual, and then but I'm going less conservative because I'm assuming maybe it's not going worse, and because of the profit margin is going up, I'll reduce it to the -3%, but still I assume it will be going to be the negative, and then after 10 years I'm just selling it the company, right? If I do everything and discounted it again by the 10% rate, my value is coming only $3.71, right? So that's what my value as a whole. Okay, so which is a way different, right? So that's why we have used multiple models rather than one model, right? Okay, the another model which I also always like to use is the free cash flow model. Again, the free cash flow model, we can see I have computed the free cash flow here. The free cash flow, again, this is a negative, but the good thing sign here is the average, the free cash flow yield, as you can see, is remarkable, right? The company, although it's year over year the cash flow is negative, but still it's able to generate enough cash flow as what the price you are paying, which is 16% for the 5 years and almost 7% for the last 10 years year over year basis, which is a very good, right? But still, so that's what one of the reason there is here I just invert it, right? So the free cash flow I have taken, okay, is almost -5, but then I'm grow to, for the long term I assume it will be positive and by 2%, right? Which is nothing as grow with the economy, right? So that's what I'm doing here. And then I'll assume to sell the company as a 5 with a terminal value of 5 for the 2030 free cash flow rate, right? Which is shown here. If I use that one, then my price is $42 here. So with this model, I'm also way different. So now I have 3 models to look into, and now I say, okay, let's use all 3 models and come up with the fair value of the price, right? Okay, so now I have with the net profit model, EV model, and the free cash flow model, right? I give equal weightage to all, and just 1% extra weight to the free cash flow model. And here you can see that my price is, after giving the weighted price, and if I sum it up, my price is $38 or $39 I'm getting, but the price in the market is $19.73, so which is a huge difference. So I do believe I think the price in the of this share is undervalued. That's what I believe. So next is, let's say how it's compared with other competitors, right? Just a quickly look into from that perspective as well, and then we'll just close this video. Okay, so for that, let me go to the slides again. Okay, so far we have seen the model price. Now let's compare with this peer. So the 3 peers is the 2 other peers is the Canon and the Pitney Bowes, right? They are also in the printer business, right? So as you can see here, they are right now as 36.6 times of their earnings. Pitney Bowes is 32 times, 0.3 times of their earnings. These are in 30 ratios, and if you notice that I only give 5 times or very low 3 or 4 as the terminal value, right? Very conservative in terms of the model as far as I can go. Even by doing that, I'm getting the very low, but still the price in the market is very low. And the second thing is, you can see it's only right now trading at 17 times of his earning, right, which is half of what it's less than half of what its peer, right? So this means it still have 50% chances, 50% room to go up, and it should go up. And another reason what I find is the company has a huge cash sitting right now in its books. So there's a fair amount of chances that there should be some buyback for this share. That's what my guess is, and that's what my assumption is, right? Not just a guess. The company is paying good dividend. It's undervalued. Now the question is do I consider it as for a very long time period? For sure, no. I'm not thinking this stock to keep is for very long, but I believe it should correct in the near future, and that's for the reason I hold this company few shares as well, and I assume it will come up to within the range of at least a $10 up. Not if I'm give some room of further room to as well, so it should come that as well. So let me know what you think about this stock, and if you like this video, and give a thumbs up, subscribe if you're new, and a lot of other video in my channel, feel free to check it out, and let me know which is your favorite stock right now, which you are planning to invest, and if you can comment, that will be great to share your ticker as well. Okay, thanks for watching, and see you soon, hopefully in a new video. Bye for now.